Hello and welcome back to TCG TV. I'm Brody Tennant with Tennant Commercial Group. Today we have episode 4, how to underwrite a commercial real estate deal. Okay, especially right now, we need a lot more due diligence. We really need to underwrite deals here because obviously as things change, market rates change. We want to make sure that we are thinking about the worst case scenario, making sure that this deal makes sense even in the worst of times. So there's going to be 4 major things that we'll be looking for. First one's going to be NOI, cap rates, debt ratio, and then cash on cash return. So first, let's define what all of these are. So NOI, that is net operating income. Net operating. Sorry, I have terrible handwriting with this thing. Income. Next is debt ratio, cap rate. Okay, and that's basically your ROI, your return on investment, or your purchase price, or your NOI over your purchase price. Okay. So ROI, and then debt ratio, which is basically your NOI over your debt service. So what are you annually getting in rent per year over what are you annually paying in debt service per year? NOI over debt. Then last is cash on cash return. Basically going to be your NOI minus your debt service is your cash flow. Over your amount of money you put down, so your down payment. How much cash you have in the deal. So first, let's find out NOI. Okay. So I'm going to use a deal we had in particular, which was a 4-unit retail deal that we did a few months ago. The purchase price was $1.4 million. So we take together all the rents out of all 4 units, and the rental income total was $190K. So from there, give me a sec, we have to factor in our vacancy factor. First particular deal, we did a 10% vacancy factor. So multiply that by 90%. So 190, that's 0.9, gets you to 171,000. Okay. From there, we have to factor in expenses. So for this particular deal, you have to go through all the leases and find out exactly what makes what the expenses are, what is responsible for the tenant to take care of, and what is responsible for the ownership to take care of. So this particular deal was all triple net leases, but they were not absolute triple net leases. Absolute triple net leases, the ownership would take care of nothing. But in this particular deal, the roof and the structure was responsible for the ownership. All the property taxes, the insurance, and all common area maintenance was still responsible by the tenant. So we don't have to factor in property taxes, insurance, or common area maintenance. We do have to factor in for those capital expenditures in the roof and the parking lot and the rest of the structure. So the way that we do that, if you take what the expenses are, let's say what's the life expectancy for a roof, what's the life expectancy for a parking lot or the other major expenses, and then we find out what is the exact cost of that. Okay, so we take that entire expense and we divide it by the life expectancy in years. So we find out average what we should be putting away per year so that's paid off by the time it has to be replaced. So for this particular deal, so we put away $7,000 per year for roof and parking lot replacement, which we call our capital expenditure expense. We also put away $3,000 a year for tenant replacement. So these tenants have been here a long time, but whenever they do have to be replaced, there's going to be a cost to that. We're going to have to pay another broker on the other side who's going to be representing the tenant, or we may have to do some improvements to the inside of the building, some tenant improvements. So we factor that in as well. We call that tenant improvements or commissions. Gets us to $10,000 per year. And that should give us a pretty safe buffer whenever these vacancies come up and these large capital expenditures do come up. So we take that 171 minus $10,000. $171 minus 10 gives us $161,000 of NOI. Okay, simple enough. So $161,000 of NOI. So you buy the property for $1.4 million, gets you an NOI of $161,000. Now we need to find out cap rate. Okay. Now again, that cap rate is $161,000 over the purchase price. NOI purchase price of 1.4, which is the purchase price. So calculate that number. 161,000 divided by 1.4 million. Get you to an 11.5% cap rate. So, and this is really going to vary. You know, like cap rates are really going to vary from anywhere from down 4% all the way up to 15% on some really risky deals. So obviously lower cap rate, the more secure this asset is, and the more it's stabilized, and the more national or more credited tenant you have in there. So there's Starbucks, CVS, and long-term leases that trade as low as a 4% cap rate. And there's obviously some properties that have trouble with vacancy or having trouble getting leased up or very expensive in maintenance. That can be a higher cap rate. This particular deal, we had 11.5% cap rate, which we were pretty happy with, given the location, given the mix of tenants for this property. 11.5%. Okay. Now, for debt ratio, we have to find out what is our debt every single year. So for this particular deal, we put $350,000 down, which was exactly 25%. So that left a remaining loan of 1.07. And at 20-year amortization, again, like when you're figuring out your amortization schedule, you can go online. You can use an online service for the schedule. We have a database where we actually do the equation ourselves. But when doing that, you need to find out the exact amortization rate, not the term. So that amortization rate is going to be how long is that loan spread out over time. Okay. So we were 20-year amortization at 4.25% interest on a commercial loan. We were pretty happy with. So that got our monthly payment to just over $6,600 per month. And then over an annual basis, our debt was just under $80,000. So we'll use $80,000. And again, that debt ratio is going to be your NOI, 161,000, over your debt service. This is NOI over debt. That gets that number to 2.0125. So just over 2%. And the bank's going to do this exact same thing. You know, the bank is going to take the debt, total debt on the property, and they'll factor in obviously these expenses as well. But the bank will take these into consideration, and they will think about the worst case scenario, because let's say that somebody defaults on their loan. They're going to have to take this property back over, and they want to make sure that they're in a good position that it's going to cash flow, or they can resell the property. The bank's not usually in the business of keeping property, but when they do resell it, it's a lot easier to sell if it does cash flow. Okay. So when the bank's underwriting it, they want anything over, typically before COVID, they want anything over a 1.3 debt ratio factor. Now this is 2%. This is a pretty healthy deal. But since COVID, the bank's going to be a little bit more strict, and they're going to be more conservative on what they're accepting here. So this particular deal, we were pretty happy with just over a 2% debt ratio. So the last thing we'll figure out is cash flow or cash on cash return. First thing we have to do is find out our cash flow to calculate our cash on cash return. Because again, cash on cash return is your cash flow over what you paid for the property, or what your down payment was, for the property. Our cash flow is just NOI minus debt service. So our NOI was 161,000 minus our debt service, which again was just under 80,000, but we'll use 80,000 for this. So 161,000 minus 80,000 to 81,000. So from there, we take that number, the $81,000, and we put that over. What do we put down? Can we put down 350,000? This particular deal. So 81,000 divided by 350,000 gets our cash on cash return to 23%. Now that's a pretty good return on your money there. We did like this deal. That's why we leveraged it out. We want to be cash heavy at times like this. So it does cash flow very well. And we do have cash reserves for other deals that for other opportunity does come up. So that's how you calculate those. So I'm going to throw this up here so we have all those numbers here. So we want the cash on cash return equals 23%. Okay, so those are the major factors you're going to figure in when you're underwriting any deal. You know, the NOI, the cap rate, the debt ratio, and the cash on cash return. Obviously, the higher of all those numbers, the higher the number all those numbers are, better they are. And these are things you're going to underwrite with yourself. You're going to underwrite multiple times. Okay, you're going to underwrite it yourself, underwrite it with your broker, whoever you're working with on the deal. Also, your bank's going to underwrite it. You know, so you're going to want to make sure that all of these numbers you go pretty conservative on here, because you'd rather be in a position where you overestimated your expenses and underestimated your return, and be in a better financial position than vice versa. So if you have any questions, feel free to reach out to us. We'd be happy to underwrite some deals with you. And if you need any help finding some deals, we'll be happy to help you there as well. But we'd love to be a resource for you guys. So give us a call or message us below. But that's pretty much it, guys. Thank you for watching. If you have any questions, again, reach out. But otherwise, we'll see you guys next time. See ya.